March 2020. The world is shutting down. Businesses are closing, planes are grounded, hospitals are overwhelmed. 22 million Americans lost their jobs in just 2 months. The economy contracted by 32%, the worst economic collapse since the Great Depression. And the stock market? It crashed for 3 weeks, and then it went right back up. By August 2020, the stock market had fully recovered. By December, it hit all-time highs. Let me repeat that. The worst economic disaster in 90 years happened, and the stock market finished the year up 16%. Now, you're probably thinking, okay, the market looks forward, investors were optimistic, sure, that's what they tell you. But here's where it gets weird. Because this wasn't a one-time glitch. This has been happening for decades. The stock market goes up when layoffs are announced. Companies fire thousands of workers. Stock price jumps 8%. The market celebrates bad news for real people. It rewards companies for paying workers less. It punishes businesses that actually invest in their employees. And the question nobody in finance wants to answer is simple. If the stock market doesn't reflect the real economy, then what exactly is it reflecting? Because I've been down this rabbit hole, and what I found changes everything you thought you knew about money, investing, and who this whole system was actually built for. Here's the story they sell you. The stock market is a place where companies raise money from the public. You buy a piece of a business. The business grows. You get richer. It's capitalism working exactly as designed. You work hard. You invest wisely. You dollar cost average into index funds. You diversify. You stay the course. And in 30 years, you retire comfortably. The market is just a reflection of economic growth. GDP goes up. Stocks go up. Companies earn more. Stocks go up. Innovation happens. Stocks go up. It's simple math. It's logical. It's fair. That's the story. Now let me show you the reality. The US stock market is worth roughly $46 trillion. The US GDP, the actual output of the entire economy, is about $27 trillion. The stock market is now 170% the size of the entire economy. Think about that for a second. The financial representation of the economy is bigger than the economy itself. That's not a reflection. That's a fiction. And it gets stranger. The S&P 500, the index everyone talks about, is made up of 500 companies. But the top 10 companies account for nearly 35% of the entire index. Apple, Microsoft, Nvidia, Amazon, Google, Meta, 6 companies, worth more than the entire GDP of Japan, Germany, and the UK combined. So when you hear the market is up today, what you're really hearing is Nvidia went up, and it dragged everything with it. This isn't a market. It's a handful of tech stocks wearing a trench coat. But here's where it gets worse. Because who actually owns these stocks? The top 1% of Americans own 54% of all stocks. The top 10%, they own 93%. The bottom 50% of Americans, they own less than 1% of the stock market. So when the news celebrates a market rally, they're celebrating a wealth transfer to people who are already wealthy. The stock market isn't the economy. It's a wealth scoreboard. And most people aren't even on it. Look, I'm not saying the market has zero value. It has allowed real companies to raise real capital and build real things. Amazon, Apple, Google, they used public markets to scale, and index fund investing has genuinely created wealth for millions of middle-class Americans. That part is real. But here's what they don't tell you about that index fund. When you buy an S&P 500 index fund, you're not choosing which companies to support. You're buying everything proportionally. That means when Nvidia goes up, your money automatically flows to Nvidia. Not because you chose Nvidia, because the algorithm did. This is called passive investing, and it now controls over $15 trillion. And here's the problem nobody's talking about. When $15 trillion automatically buys the biggest companies regardless of their actual performance, price stops reflecting reality. Nvidia could be overvalued by 300%. Doesn't matter. The index fund keeps buying every month, automatically, forever. Now, we get to the part Wall Street really doesn't want you to understand. Stock buybacks. Here's how it works. Company makes $10 billion in profit. Instead of paying workers more or investing in R&D or hiring more people, they use that $10 billion to buy their own stock. Why? Because executives are paid in stock. So when the stock price goes up, even artificially, they get rich. In 2023 alone, S&P 500 companies spent $795 billion buying back their own shares. That's not investing in the future. That's not innovation. That's a legal mechanism for insiders to extract wealth from a company while it's still standing and nobody goes to jail because it's completely legal. Let's talk about who actually controls the market, because it's not you, it's not me, it's not even most hedge funds. 3 names: BlackRock, Vanguard, State Street. These 3 asset managers control over $20 trillion in assets. To put that in perspective, the US government spends about $6 trillion per year. These 3 companies have 3 times that amount. And because they run the index funds that everyone invests in, they are the largest shareholders of almost every major company in America. BlackRock alone is the largest shareholder of Apple and Microsoft and Google and ExxonMobil and JP Morgan Chase. One company owning massive stakes in your bank, your tech company, your oil company, and your search engine. And because they own everyone, they have zero incentive for any one company to disrupt another. Competition is inefficient for them. Monopoly is profitable. But here's the twist. The company isn't the real story. The Federal Reserve is. Because here's the dirtiest secret in finance. The stock market isn't driven by earnings anymore. It's driven by interest rates. When the Fed cuts rates, stocks go up almost automatically. When the Fed raises rates, stocks go down almost automatically. It doesn't matter if companies are profitable. It doesn't matter if the economy is growing. What matters is, what did Jerome Powell say at 2 p.m. on a Wednesday? Think about what that means. $46 trillion in stock market wealth, the retirement accounts of millions of Americans, is being controlled by 12 unelected people sitting in a room in Washington, D.C. Not by innovation, not by hard work, not by economic fundamentals, by monetary policy. And those 12 people, they were appointed by presidents, who were funded by Wall Street, who benefits from cheap money, who lobbied for lower rates. It's a loop, a perfect closed loop. And you're investing inside it, thinking you're building wealth through capitalism, but you're actually just betting on which way the Fed will blink next. Here's the psychology they weaponize against you. Casinos figured it out decades ago. Make the environment exciting. Make wins feel personal. Make losses feel like temporary setbacks. Give people just enough control to feel responsible, but not enough to actually win consistently. The stock market learned the same tricks. Robinhood added confetti to stock purchases because dopamine is their product. Green numbers feel like intelligence. Red numbers feel like bad luck. Studies show that the average retail investor consistently underperforms the market, not because they're stupid, because the system is designed to exploit emotional decision-making. Fear, greed, FOMO, panic. These aren't bugs in the system. They're features. Because every time you panic sell, someone on Wall Street is panic buying from you. Your loss, their gain. So let me leave you with this. The stock market isn't broken. It's working exactly as designed. It was designed to concentrate wealth. It was designed to reward asset holders over wage earners. It was designed to give the illusion of participation, while keeping real control with a very small group of institutions. And the cruelest part? The people it's hardest on, the people with the least wealth, are the ones most likely to gamble on meme stocks and crypto trying to escape it, because the math of slow, boring index fund investing over 40 years only works if you have 40 years, and if you can afford to not touch it, and if inflation doesn't eat it alive first. The market isn't fake in the sense that the numbers don't exist. The numbers are real. The trades are real. The returns are real. But the narrative, the idea that it's a fair system that rewards effort and intelligence equally, that part is the lie. And the most powerful thing you can do is understand the game you're actually playing. Not the one they told you about in school. Not the one CNBC narrates every morning. The real one. Because once you see it, you can't unsee it. Share this video to someone who still thinks the market is fair. Maybe it'll change how they see things. And if you want more of these deep dives into the truth they don't want you to find, subscribe to the channel, because the next video goes even deeper. See you there.